Everyone tells you investing is the path to financial security. Just put your money in the market and let time work its magic, they say. Historically, stocks always go up, they promise. But what if we told you that everything you've been taught about investment safety is built on a dangerous lie? Here's what nobody wants to admit. 96% of actively managed funds fail to beat the market over 15 years. The average investor has lost money in every major market decade, except one since 1926. And here's the kicker. Even safe investments like bonds and CDs are quietly destroying wealth faster than most people realize. The shocking truth isn't just that investing is risky, it's that the entire concept of safe investing is a myth designed to keep you comfortable while your purchasing power slowly disappears. And if you're new here, make sure to subscribe and hit that bell icon. This channel regularly exposes the uncomfortable realities about money and investing that financial advisors don't want you to discover. Trust us, what you're about to learn will change how you think about financial safety forever. Let's shatter some illusions. Shocking reality number 1. The biggest risk isn't market crashes. It's inflation silently stealing your wealth. Everyone fears dramatic market drops because they're visible and scary. But there's a wealth destroyer that's been operating in plain sight for decades, and most people don't even realize they're being robbed. Inflation. Since 1913, the dollar has lost over 96% of its purchasing power. What cost $1 then costs about $26 today. That's safe savings account earning 0.5% interest. With inflation running at 3 to 8% annually, you're guaranteed to lose money every single year. Even worse, official inflation numbers don't reflect reality for most people. Government calculations exclude food and energy costs. You know, the things you actually need to survive. Real inflation for everyday expenses has been much higher than reported for years. This means your conservative portfolio of bonds and CDs isn't preserving wealth, it's systematically destroying it. You might feel safe watching your account balance stay stable, but your actual buying power is evaporating month by month. The cruel irony? The assets people think are risky, like stocks and real estate, are often the only investments that have historically outpaced inflation over time. What we call safe is actually guaranteed wealth destruction in slow motion. Shocking reality number 2. Market crashes aren't rare events. They're the system working exactly as designed. We're told market crashes are unexpected black swan events that nobody could see coming. This is complete nonsense. Major market corrections happen roughly every 7 to 10 years like clockwork. Since 1929, we've had the Great Depression, Black Monday, the dot-com crash, the 2008 financial crisis, and the COVID crash. Yet every time it happens, the financial media acts shocked. Nobody could have predicted this, they cry, while experienced investors quietly buy the dip because they know this is exactly how markets work. Here's what's really happening. Markets don't crash randomly. They crash when excessive speculation and leverage reach unsustainable levels. The system builds up pressure like a volcano, and eventually it has to release that pressure through a dramatic correction. The shocking part? These crashes aren't bugs in the system, they're features. They transfer wealth from panicked investors to patient ones, from the leverage to the prepared, from the emotional to the rational. If you're investing without expecting regular 20 to 40% drops in your portfolio value, you're not investing, you're gambling. And when that inevitable crash comes, you'll join the ranks of people who sell at the bottom and swear off investing forever. Shocking reality number 3. Diversification is the biggest lie ever sold to investors. Don't put all your eggs in one basket, they say. Spread your risk across multiple asset classes, they advise. But here's what they don't tell you. When markets really crash, diversification disappears exactly when you need it most. In 2008, stocks crashed, bonds crashed, real estate crashed, commodities crashed, everything fell together. The same thing happened in March 2020. When fear takes over, correlations go to 1.0 comma, meaning everything moves in the same direction, down. The only thing that didn't crash? Cash, which was being systematically devalued by money printing. So you could either lose money in falling assets or lose money to inflation in cash. Some choice. Traditional diversification gives you the illusion of safety while ensuring you'll be mediocre at best. You'll never lose everything catastrophically, but you'll also never build significant wealth. You're diversified into guaranteed mediocrity. The really successful investors we study aren't diversified. They're concentrated in their areas of expertise and hedged against specific risks they understand. Diversification is what you do when you don't know what you're doing. Shocking reality number 4. Your retirement plan is based on assumptions that no longer exist. The entire concept of retirement planning is built on historical assumptions that have fundamentally changed. The classic 4% rule assumes you can safely withdraw 4% of your portfolio annually in retirement. But this rule was created when bonds paid 6 to 8% interest and stocks were reasonably valued. Today, bonds pay almost nothing, stocks are at historically extreme valuations, and life expectancy has increased dramatically. The 4% rule now has a significant chance of leaving you broke before you die. Even worse, the retirement timeline itself is breaking down. People used to work for 40 years and retire for 10 to 15 years. Now people work for 40 years and might live 30 plus years in retirement. The math simply doesn't work anymore. Social Security is projected to be insolvent by 2034. Corporate pensions have largely disappeared. Healthcare costs are exploding. The three-legged stool of retirement security has lost all 3 legs, but financial advisors are still using the same old projections. We're facing the first generation in American history that might be poorer in retirement than their parents, despite following all the traditional advice about saving and investing. Shocking reality number 5. Index funds have created a massive bubble that nobody wants to acknowledge. For the past 15 years, we've been told that index fund investing is the safest, smartest way to build wealth. Just buy the whole market and hold forever, right? But this strategy has created unintended consequences that threaten the entire system. Trillions of dollars now flow automatically into index funds every month through 401(k) contributions and automatic investing plans. This money doesn't care about valuations, earnings, or fundamentals. It just buys whatever stocks are in the index, regardless of price. This has created artificial demand for large cap stocks and distorted market pricing mechanisms. Companies get included in major indexes not because they're good investments, but because they're big enough. Meanwhile, smaller companies that might be better values get ignored. When this passive investing bubble eventually bursts, and all bubbles burst, it won't matter that you were safely diversified in index funds. You'll be holding overvalued assets that everyone is trying to sell at the same time, with no fundamental buyers to support prices. The irony is that index fund investing only worked because most people weren't doing it. Now that it's become the dominant strategy, it's planted the seeds of its own destruction. Shocking reality number 6. Technology has made markets more dangerous, not safer. We're told that modern technology has made markets more efficient and safer for investors. Sophisticated algorithms, real-time data, and instant execution should reduce risk, right? Wrong. They've created new categories of risk that didn't exist before. High-frequency trading algorithms can cause flash crashes that wipe out billions of dollars in seconds. We've seen stocks drop 99% in milliseconds due to algorithmic errors, only to recover minutes later after destroying anyone with stop-loss orders. Social media can now move markets instantly based on rumors, memes, or coordinated campaigns. A single tweet can add or subtract billions from a company's market value in minutes. We've entered an era where market movements can be completely disconnected from economic reality. Even worse, the complexity of modern financial instruments means that most people, including many professionals, don't really understand what they own. Remember 2008? AA-rated mortgage securities turned out to be worthless, but nobody understood the risks until it was too late. Technology hasn't made investing safer. It's made it faster and more complex, which actually increases risk for individual investors who can't keep up with algorithmic trading systems. Shocking reality number 7. The safety you think you have is actually the most dangerous position of all. Here's the most shocking truth. Feeling safe about your investments is probably the most dangerous financial position you can be in. Safety is an illusion that prevents you from preparing for reality. When you believe your portfolio is safe, you stop paying attention. You don't monitor risks, you don't have backup plans, and you don't prepare for scenarios outside your comfort zone. This false sense of security sets you up for devastating losses when reality inevitably intrudes. The investors who survived and thrived through major market crashes weren't the ones who felt safe. They were the ones who understood that nothing is guaranteed and prepared accordingly. They had cash reserves, multiple income streams, and the emotional fortitude to act when others were paralyzed by fear. Safety isn't about avoiding all risk. It's about understanding and preparing for the risks you can't avoid. The safest position is being prepared for danger, not pretending it doesn't exist. Most people spend more time researching their next car purchase than understanding the risks in their investment portfolio. They delegate their financial future to advisors who profit from keeping them comfortable, not from keeping them safe. Here's the uncomfortable truth. There is no safe path to building wealth. Every strategy involves risk, and the biggest risk is often the one you're not thinking about. But this doesn't mean you should avoid investing. It means you should invest with your eyes wide open, understanding that volatility and uncertainty are the price you pay for the opportunity to build real wealth. The goal isn't to find safety, it's to find strategies that can survive and thrive despite uncertainty. That means having realistic expectations, multiple backup plans, and the emotional strength to stay rational when everyone else is panicking. Don't let the illusion of safety rob you of the vigilance you need to protect and grow your wealth in an uncertain world. Thanks for watching. If this shattered your illusions about investment safety, hit that like button and subscribe for more uncomfortable truths about money and investing. Until next time, invest with wisdom, not wishful thinking.